This is your LMAX Exchange Technical Update for Thursday, June 29, 2017. Euro dollar. So the euro continues to extend its run in 2017 with the market pushing up to another 2017 high on Wednesday and looking to extend that run again into Thursday trade as it trades up into critical major resistance in the form of the 115 to 117 area, which has capped the market. If you go back to 2014, we've seen a consolidation since 2014 where the market has come up several times into this area and once again is coming up towards testing this area. So to expect the euro to stall out around current levels would be unfair at this point, and there is room for this market now to extend up towards that 115 to 117 critical resistance zone. Remember, this recent breakout this week above 113 to a fresh 2017 high followed a period of consolidation between 113 and 111, and so that 200-point consolidation projected to the top side on the break of 113 takes us up to 115. So the expectation over the coming sessions is that this run will continue at a minimum up towards the 115 area. At this point, 111.10 is a critical level of support, and a break below that level would be required to take the immediate pressure off the top side. Sterling dollar. So cable has seen a really nice run over the past several sessions with the market extending back up towards 130. Overall, however, we've seen mostly some choppy consolidation since the market broke out in April, trading up to a 2017 high above 130. There is risk over the medium to longer term that the market extends now up towards that next key measured move extension at 135. This, of course, because of the market breakout that we'd seen above critical range resistance, which was in play earlier this year at 127.75, and the break signaling a bottom, a longer term bottom at that plus 30-year low that we'd seen back in October 2016 at 118.40. But again, right now, although the market has seen an impressive recovery, we shouldn't rule out the possibility for more choppy trade here and the possibility for another downside move. Again, ultimately, the structure is now shifting to a more bullish structure following the break above 127.75, exposing a move up towards 135, but on a short-term basis, there is risk for more choppy trade ahead. Dollar yen. So dollar yen pushed up through some short-term resistance at 112.13 this week, and this takes some of the immediate pressure off of the downside, but overall the market still remains confined to a downtrend while below that 114.37 high that we'd seen back in May, and so any rallies that we do see from here could once again be well capped ahead of a fresh downside extension, eventually taking us back towards that 2017 low just ahead of 108. Euro Swiss. So Euro Swiss has been chopping around over the past several sessions. The market had recently, in recent weeks and months, broken up towards psychological barriers at 110, but had been unable to establish above that critical psychological barrier. If the market can establish above 110, it will force a meaningful shift in the structure here and suggest that we're seeing a longer-term base in Euro Swiss. If, on the other hand, the market is unable to sustain rallies up towards 110 and above 109, there could be another downside break with an acceleration seen back below recent lows, which come in around the 108.30 area, taking us down towards some critical support in the 106s. But overall, again, while the market holds below 110, there is a longer term downtrend that still is intact. Aussie dollar. So Aussie has been very well supported on rallies up towards the 76 area, but on Wednesday the breakout above 76 and clear breakout above some previous resistance just over 76 does set up the possibility now for this market to extend some more over the coming sessions, with a possibility for a retest up towards the 2017 high at 77.50 that was set back in March. Overall, this is a market on a medium to longer term basis that has been very well capped into rallies up towards 78. So if we do see this run extend up towards 78, expect the market to then be very well capped. Right now, we would need to see a breakdown back below 75.35 to put the pressure back on the downside. Dollar CAD. So dollar CAD has seen a very impressive pullback over the past several days since the market put in a 2017 high all the way up around 138. We're now trading down to a major psychological barrier here at 130, but overall on a medium term to longer term basis, the market is expected to start to find some solid support in the 130 area, and only a close below the psychological barrier would suggest that the market could be seeing a more meaningful shift. Until then, there's risk over the coming sessions that we see a significant bounce in dollar CAD, with the market potentially looking to resume a longer-term uptrend. Of course, the market on a short-term basis would need to break back above 133.50 to suggest that this is true and would strengthen the bullish resumption case. Kiwi dollar. So the New Zealand dollar has continued to be very well bid over the past several days, with its recovery extending out from 2017 lows around 68.20, and there is now scope for the market to want to extend up to retest and potentially break the 2017 high at 73.76. But much like the Australian dollar, this is a market that is also very well capped on a medium to longer term basis up around current levels here in this market. And so if we do see the market push up towards 73.76 and above, expect the rally to then be very well capped ahead of 75. But for the time being, a break back below some recent support now, which comes in around 72, would be required to put the pressure back on the downside. SPX 500. The S&P 500 refuses to back down, and we had talked about the possibility of the market reversing or at least taking the pressure off the top side only on a break below 2400. And although we did see a bearish formation on Tuesday, that was once again proven correct in terms of not wanting to get too bearish this market until we break below 2400, with the market reversing course sharply in Wednesday trade, putting in a bullish outside day. And so the focus remains on the top side here, and the breakout that we had seen several days back above 2400 does set the stage for a continuation of gains towards a measure move extension into the 2480 area. At this point, again, it would take a break back below 2400 to suggest that the market could be putting in some form of a top, and at a minimum take the pressure off the top side. Gold. So gold continues to be very well supported on dips in recent months, certainly in 2017, and over the past several months the market has been putting in higher lows and higher highs, and so these latest setbacks that we've seen down towards into the 1230s could be supported now in favor of that next higher low above 1214, a previous higher low from back on the 9th of May, ahead of a continuation of gains and resumption of this uptrend, with a break back above 1296, the current 2017 high, to confirm and accelerate gains towards the 2016 peak at 1375 further up. Only back below a recent low that we had seen around 1214 would compromise that higher low from at 1214 from the 9th of May, would compromise the constructive outlook for gold.